Today, we are digging into the economic outlook from Mohammed El-Erian to try and make sense of the deeply confusing signals the economy is sending us. So let's just start with the big question that seems to be on everyone's mind. Is the US economy actually strong, or is it secretly weak? I mean, the headlines seem to give you a different answer every single day, right? Well, it turns out there's a very good reason for all that confusion. On the one hand, when you ask him to cut through all the noise in the latest jobs reports, El-Erian is pretty clear. He says that the underlying signal, despite all the distortions, really points to a labor market that's getting weaker. But then, almost in the same breath, he says this. He expects the headline number for the economy, GDP, to show continued solid growth. So wait a minute. How can both of those things be true at the same time? A weakening job market and a strong economy? That's the puzzle we're going to solve today. All right, so here's our game plan. First, we'll tackle why all the data feels so contradictory. Then, we're going to explore what he calls the great decoupling. After that, we'll look at the most likely scenario for 2026, and then the two wildly different futures that could also happen. And finally, we'll unpack his key advice for navigating this pretty uncertain world. Okay, so let's kick things off with this confusing economic picture and really get to the bottom of why the data we're getting feels so all over the place. You know, El-Erian's point is that we shouldn't get too hung up on any single month's jobs report because, as he puts it, they're filled with so many distortions. But if you zoom out and look at the bigger trend, the picture starts to get a lot clearer. The strength is really concentrated in just a few areas, like health and education, while other parts of the job market are definitely struggling. So this brings us to the core of his argument, the thing that explains this whole strange situation. He calls it the great decoupling. This new phenomenon where the top-line economy and the job market are actually moving in different directions. And this slide, it really paints the picture perfectly, doesn't it? On one side, you've got strong GDP, and that's being driven by high-end consumer spending and just massive corporate investment. But on the other side, you've got a weakening labor market, which reflects all the pressure on lower-income households and the weakness across a bunch of other sectors. So what's causing this strange split? El-Erian points to a new, incredibly powerful ingredient in the economy, artificial intelligence. AI is what's really fueling this. You see, massive investment in things like data centers drives up GDP, but it just doesn't create jobs in the same way that traditional investment does. And at the exact same time, lower-income households are getting squeezed by affordability issues, high debt, and maxed-out credit cards. This whole dynamic creates what El-Erian calls a K-shaped economy, where the top is rising while the bottom is falling. You know, this might be why you hear about a booming stock market, but your own grocery bill feels heavier than ever. So, if that's the strange reality of today, what about tomorrow? This is where El-Erian's framework gets really fascinating, because he doesn't just predict one single future. He maps out several distinct possibilities. So he sees the future as a distribution of probabilities. His central scenario, or what he thinks is the most likely outcome, has a 50% chance of happening. But then look at this. He gives a 25% chance to a major upside surprise and an equal 25% chance to a pretty significant downside risk. Let's look at that 50% case first. This is a world where the US continues to see solid growth, probably above 2%. It's fueled by continued government spending and that massive private investment in AI we talked about. And honestly, compared to the rest of the world, the US economy looks incredible in this scenario. But here's the thing, and this is absolutely crucial. A 50% chance is not a guarantee. The other 50% of possibilities are split between two radically different futures, what statisticians call the fat tails of the distribution. And El-Erian warns we need to pay very close attention to them. In his own words, these aren't just some small risks on the fringe. The chance of a non-inflationary boom is just as high as the chance of a stagflationary crisis. So let's break down what those two very different worlds could look like. Okay, the upside case. This is a full-on productivity boom. This happens if corporate America shifts its focus from just creating new AI models to actually adopting the incredible AI technology that already exists. If companies start using AI to enhance labor and improve efficiency across the board, it could unlock a massive productivity surge. And for you, that could mean higher wages without higher prices. I mean, that's the best of all worlds, right? Now, for the other side of the coin, the downside risk. And this scenario is rooted in a simple but absolutely massive problem: debt. The US is currently running a deficit of 6% of GDP, and all of that, plus all the private sector debt, needs to be funded somehow. And this leads to the critical question that defines the whole downside risk. See, the US has been able to borrow cheaply for years because investors have had this huge appetite for its bonds. But El-Erian asks, what if that appetite suddenly just goes away? If the bond market starts demanding much higher interest rates to fund US debt, it could trigger a stagflationary crisis. Borrowing costs would spike for everyone, choking off economic growth. But, and here's the nasty part, because the problem is on the supply side of finance, inflation could remain stubbornly high. It's the classic 1970s nightmare scenario, where your paycheck buys less and your job security feels shaky. So, with these three very different potential futures on the table, the solid base case, the amazing productivity boom, and the stagflationary bust, what's the big takeaway? How are we supposed to think about a world with such divergent possibilities? And this right here is El-Erian's single most important piece of advice. And it isn't just for CEOs or policymakers, it's for all of us. The biggest mistake any of us can make right now is to become overly confident in any single forecast, whether it's for our careers, our savings, or our lives. The future isn't just a single point, it's a series of distinct possibilities. This idea of a multimodal distribution is the whole key. See, for decades, we lived in a world where things tended to kind of go back to the average. Now, we live in a world with multiple potential outcomes, and the extreme scenarios, the tails, are just as important to plan for as the central one. So we'll leave you with this. El-Erian's framework isn't just an economic forecast. It's really a way of thinking about risk and resilience in an increasingly unpredictable world. It forces all of us to ask a simple but pretty profound question. Are you only prepared for the future you expect, or are you prepared for the futures that could actually happen?